Your house is paid off, the mortgage is gone. The check you've been writing for 30 years? It stopped 5 years ago. You own it outright. On paper, that means you are wealthy. You own an asset worth $500,000, maybe significantly more. You did everything right. You followed the formula. You deserve to feel secure. You deserve to sleep through the night without worrying about interest rates or foreclosure. But here is what nobody tells you at the celebratory dinner. The moment that mortgage check disappeared, a different kind of bleeding started. It is silent. You cannot see it on a bank statement. You cannot point to one specific bill and say, that is the problem. But every single month, your paid-off house is extracting money from your retirement like a slow, steady leak in a ship that was supposed to be unsinkable. You think you are free, but you are not even close. Today we are uncovering why Gen X homeowners, the ones who did everything right, who sacrificed, who paid off their houses, and who should be sitting pretty, are actually sitting on a financial time bomb. By the time we reach the final calculation at the end of this video, you will realize that your paid-off house is the single biggest threat to the retirement you thought you already had. I am going to show you the exact ghost rent you are paying right now, a number so high it will make your old mortgage look like a bargain. Like, subscribe, and let's start. Number 1. The illusion of absolute ownership. Let's start with something that sounds insane, but it is mathematically undeniable. You own your house. The bank does not have a claim on it. There is no lender calling your phone. You won the game. You paid off the debt. You were supposed to feel secure. This was the whole point of working for 3 decades, to own something completely, to have a roof that no one can take away from you. But here is the thing that nobody explains until it is far too late for your savings. Paying off a house does not make you the owner. It just changes who takes the money from you. For 30 years, you paid the bank. Now, you are paying the government. You are paying insurance companies. You are paying contractors who fix things you never knew were breaking. And the total cost? It is often more than the mortgage ever was. Let's run the actual numbers for a typical Gen X homeowner. Imagine they are 58 years old. They paid off their house 5 years ago. The house is worth approximately $550,000 in an established middle-class neighborhood. This person is the poster child for the American dream. Here is the annual subscription fee for their free house. Property taxes, $6,000 to $9,000. In established neighborhoods, these taxes have often tripled while you were busy raising your kids. Home insurance, $2,000 to $3,500. These rates are skyrocketing because insurers are terrified of risk, and your older home is seen as a liability. Maintenance and repairs, $5,000 to $10,000. A roof does not last forever. HVAC systems have a shelf life, and plumbing eventually rebels. Utilities, $3,000 to $4,500. Gas, electric, water, and trash, all trending upward every single year without fail. Total annual cost for a paid-off house, $16,000 to $27,000. That is $1,300 to $2,250 every single month.
Think about that. When you had the mortgage, you might have been paying $1,500 a month in principal and interest. That felt like a burden. You could not wait for it to be gone. But at least that money was building equity, was going into your pocket eventually. The money you pay now, it is pure extraction. It is gone forever. It does not build a single cent of equity. It just disappears into property taxes that fund roads you do not drive on and insurance for disasters that might never happen. You are trapped in an endless payment cycle for something you already own. That isn't freedom. It's a new, invisible kind of debt that grows every year, and you cannot escape it without losing the asset itself. Number 2, the repair acceleration trap. Here is something that happens to houses around year 25 or 30. Everything dies. Everything that was installed when the house was built is now reaching its expiration date. Not all at once, that would be too easy. It is a parade of disasters spread across 5 or 6 years. The roof was shingled in the late 90s. It is now the late 2020s. That roof is finished. Replacing it? $15,000 to $30,000. The HVAC system was installed when the kids were in middle school. Now they are graduated and gone, and the compressor is screaming for mercy. A new one? $10,000 to $18,000, and that is if you do not need to replace the ductwork. The plumbing is original. There is corrosion in the pipes you cannot see. Your water pressure is dropping, and your walls are starting to weep. You are looking at $8,000 to $25,000 to repipe the entire structure. These are not emergencies. They are inevitable, and Gen X is hitting this wall right now. You finished the mortgage at 55. You imagined retirement. You planned for travel and hobbies and sleeping past 6 a.m., and instead, the house is presenting you with a bill for $60,000 in necessary repairs over the next few years. This is the part nobody budgets for. You can predict 30 years of mortgage payments down to the penny, but you cannot predict the year the roof fails, and the foundation settles, and the furnace quits. Real life has terrible timing. 3 emergencies hit at once, and suddenly you are pulling $50,000 from the savings that were supposed to protect you in your 80s. One major repair cycle can eliminate 3 full years of retirement income. Think about that. 3 years of your life, gone. The mortgage is gone, but the house is hungrier than ever. It is older. It is demanding. Every system is past its warranty. You thought you could coast, but you are actually running a marathon just to keep the roof from leaking. Number 3, the property tax explosion. Here is where the real, permanent damage happens. Property taxes do not increase with inflation. They increase with property values. And property values have gone absolutely insane. Gen X bought their houses in the 90s for $150,000 or $200,000. They did the math based on those numbers. But the house did not stay at $200,000. Over 30 years, that home became a $600,000 asset. Not because you renovated it, but because the market decided the land was precious. As your house value went up, so did your taxes. And property taxes are the one bill you literally cannot avoid. You cannot negotiate with the tax assessor. You cannot tell the government, I do not think my house is worth that much. They do not care. In 1996, you paid $1,500 a year. In 2026, you are paying $8,500 a year. The tax has increased over 500% in 30 years. The house has not changed. The square footage is the same, but the bill keeps growing. And it is going to keep growing because local governments depend on that revenue. They are not trying to be malicious. They are just passing along the rising costs of schools, fire departments, and infrastructure. A 58-year-old homeowner can expect their taxes to double again in the next 15 years. That is over $1,400 a month just for the privilege of standing on your own land, for a house you already own. And you are likely moving toward a fixed income. Social Security is not going up 500%. Your pension is not doubling every decade. What happens when the tax bill becomes bigger than your monthly income? You lose the house. Not to the bank, but to the state. This is happening to Gen X right now. They are being priced out of their own security by the very appreciation they thought was making them rich. Number 4, the selling trap. Why you can't leave. Here is the darkest part of the cage. You realize the house is a burden. You want to sell. You want to simplify. You dream about moving to a small condo by the beach and finally relaxing. But you cannot, because the moment you sell, the system takes its pound of flesh. Let's do the math on a real exit. You bought for $200,000. It is now worth $600,000. That is a $400,000 gain. 1. The transaction tax. Even if you are married and get the federal exclusion, you might hit state capital gains. In high-tax states, that could be $40,000 to $60,000 just for moving. 2. The middlemen. Realtor commissions are 5 to 6%. On a $600,000 house, that is $36,000. A stranger walks away with a year's salary for one transaction. 3. Closing costs. Title insurance, inspections, repairs to get it market ready. Add another $10,000. 4. The replacement cost.
You sell for $600,000, but the smaller place you want to buy also costs $450,000. After you pay the taxes and the agents, you have only freed up a tiny sliver of cash. You sell a $600,000 house and net maybe $500,000. You have not freed yourself. You have just shrunk your walls while keeping the same level of stress. The game does not change. You are just rearranging the furniture on the Titanic. The system is designed so that the only person who truly owns your house is everyone except you. The government, the realtor, the tax man, they all get paid before you do. So you stay, because the cost of leaving is too high. And every year you stay, the trap gets tighter. Number 5, the freedom equation, the math of the anchor. Let's talk about the dream. You imagined the mortgage going to zero and that $1,500 a month going straight into your travel fund. But the equation never actually worked that way. Old equation with mortgage. Total housing cost equals $2,500. New equation, paid off. Total housing cost equals $1,900. You did not save $1,500. You saved $600. And that $600 is immediately swallowed by the fact that your house is 30 years old and needs a new roof. You paid off the mortgage and freed up almost nothing. It is like paying off one debt just to discover a second, secret debt hiding underneath it. The bank was just the most visible creditor. The insurance company and the tax collector were waiting in the shadows the whole time. And what about the indirect costs? You are carrying a $500,000 asset that you are terrified to touch. You are house rich and cash poor. You cannot eat the drywall. You cannot spin the foundation. The psychological weight of this is massive. You feel trapped. You watch your retirement account get eaten alive by a house you cannot sell and cannot escape. The asset that was supposed to be your safety net has become your anchor. The system is designed to extract value from your home, not provide it to you. Number 6, the final audit, the cost of being free. Let's look at the absolute truth, the answer you weren't supposed to find. If you are a Gen X homeowner with a paid-off house worth $550,000, you are not living for free. You are paying a ghost rent of $2,100 every single month. How? It's the $800 in property taxes. It's the $300 in insurance. It's the $500 set aside for the inevitable roof and HVAC failure. And most importantly, it's the $500 in lost investment gains because your $500,000 is sitting in a pile of bricks instead of a growing index fund. Your free house is actually a $25,000 a year luxury habit. That is the answer. That is the number that is quietly bankrupting your retirement. Every dollar that goes to the taxman or the roofer is a dollar that was supposed to fund your freedom. You spent 30 years working for the house, and now that it's paid off, the house has decided it is your turn to work for it, forever. The paid-off house is supposed to be the prize, but for Gen X, it is becoming the price. Your house does not have to own you. But it will unless you stop looking at it as an asset and start seeing it for what it truly is. A very expensive place to sleep. The math of wealth isn't about having a roof you own. It's about having the freedom to walk away from any roof at any time. One provides comfort. The other provides true power. Make sure you know which one you are actually buying before you sign that final check. I'll see you in the next video.